My guest today is Amanda Lynam, Managing Director and Head of Macro Credit Research at BlackRock. Amanda heads original market research across diverse asset classes, including private debt, global corporate debt, as well as real estate lending. Amanda, thanks so much for coming in today.
Thanks so much for having me.
It's great to see you. I'm very excited to have this conversation today about private credit, but also we'll weave in a little bit of public credit discussion as well, because you've spent your career covering IG, high yield leverage loans, and now, of course, private credit at BlackRock. So let's start with, what is the outlook for you for private credit heading into 2025?
We have a structural growth forecast for private credit that is fairly optimistic. We believe that the asset class can grow to $4.5 trillion by 2030, which is about a 15% compound annual growth rate from the current figure. That growth forecast is underpinned by four factors. One is investors' desire for diversification and increased comfort with the asset class. Two is borrowers' desire for certainty of execution and flexibility. The third, which I don't think is talked about enough, are structural shifts in the public debt and equity markets, which we think are allowing private credit to fill a financing void. And then fourth is ongoing selectivity in bank lending that has allowed private credit to establish itself as this third and viable funding option alongside the banking markets, alongside the public debt markets, which on net we think is a positive for financial stability. I think the one really important point, if we were having this conversation 2 years ago and we were talking about private debt or private credit, we would have been talking about lending to middle market companies. Really, that would have been the focus. I think over the past 2 years in particular, the definition of private credit has really changed. It's now
Expanded.
It's broadened and it's expanded, and I think it encompasses a much wider range of opportunities, and really anything that can be originated, structured, and held by a lender is now in the purview of private credit. So that may explain why we have such a optimistic growth forecast on this asset class, because we think that it's actually expanding into new areas of finance.
I'm glad you brought that up, because it does seem to me like it's a little bit more optimistic than even some of the consensus analyst forecasts are for the growth of private credit to go, again, from $1.7 trillion today to $4.5 trillion by 2030. So why do you think BlackRock is somewhat more optimistic about private credit?
I think we're undergoing a bit of a paradigm shift in private credit on a few fronts. One is there's a lot of scope for the traditional institutional investor community to increase participation and allocations in private credit, especially when you think about alternative asset allocations in private equity or real estate, which are actually much larger. So I think there's a lot of scope for growth there. But then we see new avenues of investor participation: insurance companies looking for capital efficient yield, retail investors looking for income and portfolio diversification. The growth of certain BDC structures has allowed retail investors to access private debt in a more simple and efficient way. That expanding addressable market of investors is one kind of part of that equation. The second is the expanding addressable market of borrowers. So private credit is now sizable, scalable in its own right as an asset class, meaning it can compete in areas where it previously could not, including the public debt markets. It's also servicing investment-grade borrowers, many of whom may have saturated the IG debt markets across currencies and are looking for private solutions. So I think the definition of private credit is changing. The addressable universe of both investors and borrowers is changing, and I think that's really fueling our above consensus forecast.
So that's the great part of the story. But, there's definitely some skepticism out there that I hear about, well, just how great this growth story is. And is it too great? Is it, in fact, a bubble that there's so much money chasing private credit, and it seems like every manager, every investor wants to be in the asset class? So what do you say to that? Is private credit in a bubble? Are there any concerns?
So the stat that gives me a lot of comfort related to that is actually the amount of capital that is going to first-time private debt managers versus established private debt managers that have 4 or more vintages. And if you look at the data from Preqin, since 2022, when the Fed started hiking rates, actually private debt established managers, so 4 or more vintages, have captured 86% of the fundraising, which is actually well above the trend of 2019 to 2021. The flip side of that is that new entrants in private credit have raised only around 2 to 3% of total capital since that time, since 2022. So to us, what that means is, as the Fed was raising interest rates, as the cost of capital was becoming more onerous, investors were more discerning about where they were allocating capital. To me, that shows the discipline is still alive and well in the market. And that is something that I think we would expect to hold going forward as investors seek to do business with fewer asset managers and really focusing on those that have the depth and breadth of expertise. And for, I think importantly, the workout and restructuring knowledge if it comes to that. The other stat that I would say is that actually as this asset class has continued to grow and kind of age, the loss performance has actually been fairly constructive, both in its own right, absolute terms relative to the income generation, as well as loss performance relative to public credit. And I think that has given a lot of investors comfort so that when they think about private credit, and it goes back to your earlier question, why do we expect this growth? I think as time has gone on, investors are questioning whether or not a neutral or underweight allocation to alternatives more broadly, and especially private credit, makes sense.
Right. And certainly when you look at the statistics and you look at the risk adjusted performance of private credit, it fared far better versus the publicly traded high yield and leverage loans. And if we look at the forecast, we're still expecting higher returns with lower volatility. So I think investors are starting to really understand that. And there's certainly a place for that in the portfolio. But Amanda, let's talk about the public versus private, because that's still the question that inevitably comes up. And especially in this environment where public markets are now wide open and we've seen the broadly syndicated issuance of high yield and leveraged loans and IG paper really pick up, and in some cases to record levels. So is that set to displace some private credit? Is it going to refinance some of the transactions? And does that kind of stall the growth that you were describing?
We see a world in which all of these markets kind of coexist peacefully amongst each other. I think for a lot of borrowers, the decision is where can they get the best mix of pricing, certainty of execution, and flexibility. Some borrowers, that will point them to the public markets. Other borrowers, that will point them to the private markets, depending on where they are in their growth journey. We already know that even as the syndicated leverage loan and high yield bond markets have been wide open for the past few quarters, actually we're seeing data that shows private credit refinancing debt that was in the public markets and vice versa. But I think what it just shows is that that kind of financing mix, as we refer to it, will ebb and flow over time. There will be periods of time, choppy markets like when we saw early August, where private debt can step in and provide kind of certainty and of execution and really provide that financing. And there are periods of time where it will skew more towards the liquid side. But I think these are kind of long-term trends. As we know, markets will be in flux. Markets are wide open today, but they could change very quickly. But we don't view that as curtailing the growth backdrop, because for a lot of borrowers, it's not just about price, but it's also, do they really value that long-term relationship with the lender?
And sounds like there's no shortage of opportunity, really, for both public credit facilities as well as private credit. And speaking of opportunity, my last question for you, Amanda, is just where exactly do you see the biggest growth opportunity today? Is it in the U.S.? Is it in Europe? Is it in direct lending? Is it asset-backed finance or something else?
Sure. I'll point maybe first to a trend that our colleagues in the BlackRock Investment Institute have pointed to, which is the build-out of artificial intelligence and the significant amount of capital investment that will require. Their estimates is that that will require $3 trillion of capital investment by 2030. The quantum of financing likely cannot be solved alone by governments and public debt markets. So I'd say there's a very real role for private markets and private debt in particular to play in the financing of those longer term structural shifts, most of which will require multiple rounds. And so I'd say private asset-based finance, lending to IG borrowers, financing for these longer term structural shifts is, I would say, first on the list. There's also a lot of scope for growth outside of the US. So North America is by far the largest market for private credit, but actually there's a lot of growth still to happen in that region, and in Europe and Asia, where the economies are more reliant upon bank lending. We also see an opportunity for that diversification of funding sources to really gain some momentum. Those are very regional, heterogeneous markets where local expertise is really important. And then third, I would just say, is the ongoing expansion across investor bases. So insurance, retail investors, in addition to the traditional institutional investors that are asset liability matching. There's multiple facets of the growth forecast. We see actually multiple avenues of growth going forward.
Amanda, thank you so much for sharing your perspective on all of that today, and really enjoyed hearing about the growth that you see in private credit, what's driving it, as well as helping us really understand how to appropriately evaluate that growth and really having to, size that up against the size and scale and what is it ultimately doing, which is partnering with some of the private equity sponsors. So Amanda, thank you so much for that, as well as outlining the opportunities.